Welcome back. We are going further and further into our series on federal student loans. And if you were here in the last video, we covered some of the ways being married affects your student loan payments. Well, today we're going to go a little further in that topic. We're going to talk about things like how being married affects your student loans in death, even if you were to get divorced, and the differences between being married and having things like federal student loans versus private student loans. Let's get started. One of the consistent questions that I get from married couples where either one or both have significant student loan debts is, what happens to my debt if I die? Is my spouse responsible for paying it off? Am I leaving a burden to my family? And to go through the explanation, we have to separate into the differences between federal student loans and private student loans. The good news here is with federal student loans, they die with you. They are discharged on your death. So if I have federal student loans and I die, my wife and my family will not be responsible for paying that off once I'm no longer here. However, private loans, you have to look through the details of your loans because while some discharge your loans at death, others do not, and that would be an obligation that your family would have to pay. So what if you're in a situation where both of you have student loan debts? How do you make sure that the other is provided for in the event of your death? Well, let's say that I have $200,000 of student loan debt and my wife has $100,000. Now remember, if I die, she won't be responsible for my debt, but she still would have student loan debt of her own that she would be responsible for. So to make sure that each side is okay if the other were to pass, oftentimes what we'll recommend is putting life insurance on yourself that will cover your spouse's student loan obligation when you die. So in this example, I die with $200,000 worth of debt. So that's not the amount that I'm concerned about. But I would want to make sure that I have a life insurance policy on myself of at least $100,000 so that my wife can pay off her debt in the event that I die. So while it's not a burden in terms of what you left behind, if you can provide a little relief for anything that your spouse would have to pay for on their own, then that's a good strategy to take forward when it comes to dying with student loans. Now, a tough topic. What if we get married and then we unfortunately get divorced and we both or one of us has student loan debt? I'll tell you, I'm going to touch on this very lightly for a couple of reasons. Number one, I'm not an attorney. And number two, all of these things can be subject to the state that you live in this situation. Now, it is not uncommon for a court of law to see any debt that you take into the marriage as yours when you exit the marriage. Meaning if I come into the marriage with student loan debts and we're divorced, that could be seen as something that's not my soon-to-be ex-spouse's responsibility if we were to split. However, if you take on loans during a marriage, then how you take on those loans and how responsible or how able you are to pay off those debts when you split could be something that changes a ruling based on the state that you live in. So for example, you might live in a state where you come in and you are in a marriage and you take on debt during that marriage. And while it's for your schooling, if you split and the judge feels like you can't afford those payments, it may be something that they consider an obligation of your ex-spouse. Or you could be in a state where anything that you sign up for, the judge sees as completely your own. It's all dependent on where you're living and how you took on that debt. Now, something that is just tried and true is if you co-sign for your spouse's student loan and you divorce, it doesn't matter if you divorce or die, if you are sitting as a co-signer, that is your responsibility. So you either have to take care of in a divorce proceeding how that debt will be handled between the two of you, but if you don't, you would be in a situation where even though you're no longer with that person, that is a joint obligation that you took on during your marriage. So you want to make sure that if you have any doubts, if you think that that might be a possibility for you, then you guys need to have a conversation about how you want to take care of that in the event that you do decide to split. Now, a lot of people ask, how do my spouses or how do my student loans affect our marriage in terms of our credit? And how does it affect us in terms of qualifying for a mortgage or a home loan? And to talk about that, we really have to go into the differences between private loans, co-signed loans, and federal loans. Because again, if you do not have your name on a loan, it doesn't show up on your credit report. So on a federal student loan, if your spouse has a loan, that is their loan. There is no joint score. The only way it would show up on your score is if you co-signed on a loan with your spouse. So other than that, your loans are your loans and your spouse's loans are their loans when it comes to credit. Now, when it does come into play is if you are trying to qualify for a home loan. And to tell you how it comes into play, especially when it comes to income-driven plans, we have to talk about the debt-to-income ratio. So new term, debt-to-income ratio is literally a measure of what percentage of your monthly income is taken up by your monthly debt payments. So just for my easy math, let's say that you have a household income of $10,000 a month, and that's before taxes. And when you look at all of your debt payments, let's say that they total $5,000 a month. That would mean your debt to income ratio is 50%. How does that come into play when it comes to a mortgage? Well, most lenders, and the percentage differs from lender to lender, but most lenders want you to have a debt to income ratio that's pretty low before they give you access to a mortgage. So for example, let's say that a bank says that their limit on a debt to income ratio is 35%. And if you have a $10,000 monthly income, that would mean that the debt payments that you make each month should not exceed $3,500 or 35% for you to look like a good risk to that bank. Once you go above that, it's highly likely that they might not issue you a mortgage, or they might have some special terms attached to it. Now, I said income-driven plans because you have to understand how they consider income-driven plans when it comes to calculating your debt-to-income ratio. If you haven't watched the first couple of videos, you need to go back to those videos. But under those income-driven plans, your lender will ask you to pay a percentage of what you make each month rather than actually paying what it would take to pay off your loan in full. And when it comes to calculating debt-to-income ratio, a bank will look at that income-driven plan and they will say, I understand that you're only paying $200 a month towards a $200,000 loan, but we have to calculate it as if you were actually going to pay that loan off in full. So let's say that if you did your own calculations for your debt to income ratio, you make $10,000 a month, and adding in your income driven payment, your debt's only total $3,000 a month. So you're at 30%, well within what they consider a good risk for what they're going to offer for a home loan. But if you look at what your payment would have been under a standard plan, and now all of a sudden, instead of $3,000 a month, your debt to income ratio is 40%. It's $4,000 a month. Even though you're not making that amount of payments because you're under an income driven plan, the bank might consider that your true debt to income ratio, because they have to calculate it off of you actually paying the debt off rather than you having that debt forgiven. So if you have a significant amount of debt, you want to go into that process and you want to be very upfront with your lender or your potential lender to see how they consider that when it comes to qualifying for a mortgage. Now, there are some loans out there that will take this into consideration in a different way, and they will consider your debt to income ratio based off of your income driven payment. And oftentimes you find that in things like a physician loan. So we work with a lot of physicians and dentists, and you'll find that they have a special loan available to them. And there are others that have special loans as well. But when you find that, you might find a lender for those types of offerings. They view it a little differently, and you want to talk to each one specifically to find out how it fits in your situation. That's it. We are done with marriage and student loans, and after the next video, we will be done with the entire federal student loan series. And in that video, we're going to cover the differences between federal student loans and private student loans. So we've talked a lot about federal student loans in this series, but next video, we'll finish up with private loans. I hope you like what you heard, and if you did, as always, please share this video with as many people as possible. We want to help as many people as possible. And if you have a topic that you want considered for a future video, you can do that by going to my website, www.brentonharrison.com, and under the blog section, there's a questionnaire you can fill out for topics to be covered in the future. I'll see you next time.